where he's like, oh my God, that was the fight over that little cut? Okay. Yeah, they're going to cut something. Sure.
Yeah. No, it's two things I like to social. Like, have they actually gotten inflation under control? Yes, the CPI has come down. They've had their pause, if you will. But it doesn't seem like it. Like, I'm seeing a lot of indicators. I actually had a friend went to get a haircut over the weekend, took a picture at the barber shop where they're making the announcement come July 1st, we're raising prices, going through an explanation of how their costs have gone up as a company and they're forced to do this. So that's like an anecdotal signal that the inflation problem may not be solved in the way that the Fed and the White House are trying to portray. Then number two, like going to like the retirement crisis and retirement funds with this bond situation going up, like a conversation on this show that I've had recently is the concept of like target date funds for retirement that have shifted all the boomers' portfolios to 80-20 bond stocks, and you have 10,000 boomers retiring a day in this environment with bonds. It does not seem like an ideal situation, and I guess that's the big question. When is the Fed going to reverse course? If they are they going to hold a hard line and keep raising rates or hold them higher for longer? Or are they going to be forced by essentially a retirement crisis to lower rates? But then again, you have the real inflation story, which is I think that they actually don't have inflation under control.
Well, and I think too, the longer this goes on, right? So fundamentally, there's no difference at the base level between a $600 billion stimmy that the government sends to everybody and a $600 billion increase in interest expense because the Fed raised rates. The only difference is really who the money goes to and the marginal propensity to consume of those that receive it. So you hand a $600 billion stimmy to everybody and that money gets spent. That's like heroin directly or injected directly into your jugular, right? Like that's now. The $600 billion interest stimmy is much more sort of like an IV drip. Drip, 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 drip. And that stuff, it goes into assets, but ultimately that money ends up in the economy at some point. And so there, in my opinion, has not been enough work done by the economic mainstream about interest rate hikes and aggressive interest rate hikes when debt to GDP is 130 per 120%, when deficits are 8% of GDP. They're inflationary. And point being is I think that's one reason that I think we're at sort of the maximum, we're getting to like the maximum deflation we can get without a crash. In other words, if they let the system crash, we'll get deflation. I mean, the Fed could have ended inflation immediately in March. Oprah, you have 800
River's
million.
The best place to buy Bitcoin. Go to river.com/TFTC, sign up today, set up an account, and start stacking sats. Back to the
Signature
video.
Bank or whatever she had, you get 250,000, have a good day. Venture Capital A, you had $1 billion too, you get 250,000. Oh, that means you need to lay off oops, they lay off their people. Those people, oh, you can't afford a house in the Bay Area? Sorry, sell it. Oh, that means those banks fail? Sorry, oops, oops, oops. You could have, if you just said, hey, we're not bailing out unsecured depositors, we would be at negative. We'd probably be at negative CPI, like by now. But Powell, it's political economy, not just economy. So the Fed showed their hand a bit, right? So number one, that's going to build on inflation. This interest is, I think, the fact that interest increases deficits and deficits are inflationary over time. That is, the longer we go, I think they're going to have a hard time getting core inflation down to the levels they want to get to. Number two, right now with headline CPI at 5.3%, a point of that roughly year over year is energy deflation. And like we just talked about before, I think that's going to start going the other direction because 90% of the world's production growth in oil over the last 10 years is rolling over thanks to the SPR releases and the rate hikes. So, I don't think we're too many months removed from oil 70, oil 75, oil's 80. And then, hey, economist at XYZ says $80 oil means actually in the next CPI print, oil's going to add a point to the headline, not detract a point, which puts us back in the sixes. So now you're looking at a world where, wait a second, I own, what do I own? The economy's slowing. inflation's reaccelerating. The SPR's run down. Why do I own the long end of the curve? Like for safety? Good luck with inflation accelerating. Like what's so you're going to get into a stagflationary type environment.